Okay, let's talk about January 21st, 2026. This was a day the Indian markets got hit by what you could only call a perfect storm. We saw these absolutely record-breaking moves in stocks, in the currency, and in gold, all happening in a single chaotic day. So in this explainer, we're going to unpack exactly what went down and trace these shockwaves all the way back to their surprising source.
It all kicked off with the stock market. At its lowest point during the day, the BSE Sensex just went into a free fall, plunging a staggering 1,056 points. I mean, that's the kind of drop that makes every single investor's heart just stop for a second.
And at the very same time, the Indian rupee was getting absolutely hammered. It crashed to a shocking new all-time low, hitting 91.74 against the US dollar. And this wasn't just a little dip, you know? This was a major breach of a huge psychological barrier.
So while stocks and the rupee were tumbling, you got to ask, where was all the money going? Well, right here. Gold prices soared to a completely unprecedented record high. One lock, 58,339 rupees for just 10 grams. It's a classic flight to safety, but on an absolutely epic scale.
So you've got these three extreme events all happening at once. It was a day of just widespread concern, wiping out nearly 6 lakh crore in investor wealth at its worst. So the big question is, what on earth could cause such a coordinated panic? To put it simply, the market got hit with a triple shock. You had investors just dumping stocks, a currency in total freefall, and this desperate rush into the perceived safety of gold. I mean, any one of these is a big deal, but when they all happen together, that signals a major crisis of confidence.
Now, here's where it gets really interesting. The trigger for all this, it wasn't a domestic policy change, it wasn't a local corporate scandal. The epicenter of this financial earthquake was actually thousands of miles away, in a dispute that, on the surface, seems to have very little to do with India at all.
So, what was it? Well, the root cause was a rapidly escalating trade and diplomatic dispute between the United States and the European Union. A geopolitical spat that just spilled over and infected global markets with a severe case of get-me-out-of-here risk aversion.
And at the heart of this big fight is something called the Greenland Bid. This was a renewed push by the U.S. administration to actually acquire Greenland, which, is an autonomous part of Denmark. And what started as kind of a geopolitical curiosity, well, it quickly turned into a systemic risk for global trade.
And this is where it got real. The U.S. administration didn't just talk, it acted. They threatened escalating tariffs on 8 NATO allies who were opposing the Greenland Plan. And just like that, a diplomatic argument became an economic weapon. And markets absolutely hate that kind of uncertainty.
And you gotta understand, this wasn't just an India story. No way. The fear went global. Wall Street had its worst day in 3 months. The Dow, the S&P 500, markets in Asia like Japan's Nikkei, they all saw major sell-offs. It was a textbook global risk-off event.
So let's trace this back. How did this global panic create so much turmoil right here in the Indian stock market? Well, it happened in a series of shockwaves. And it started with the first and most immediate one, the flight of foreign capital.
See, when things get scary on the world stage, global investors tend to pull their money out of what they see as riskier emerging markets. And yeah, that includes India. So the foreign institutional investors, or FIIs, they were net sellers, big time. All while the domestic institutions, the DIIs, were trying their best to absorb all that selling and support the market.
And we're not talking small change here. The scale of this exit was just massive. On the previous day alone, FIIs sold off a whopping 2,938 crore worth of Indian equities. And this wasn't just a one-off thing. It was part of a selling streak that had been going on for 11 straight sessions.
Dr. V.K. Vijayakumar, a chief investment strategist, really summed it up perfectly. He said the global risk-off sentiment meant one thing: sell stocks and buy gold. And that simple strategy, when it's executed by huge global funds, has a massive, massive impact on our market. Okay, so you've got thousands of crores of foreign money flooding out of the country. That creates a second, really powerful shockwave. See, to sell Indian stocks, foreign investors have to sell their rupees and buy US dollars. And that massive selling pressure is what sent the rupee into a complete nosedive.
And look, it wasn't just one thing. It was a perfect storm of factors all hitting at once. You had those huge FII outflows we just talked about. Then, on top of that, Indian importers needed to buy dollars to pay for goods. And the overall mood of geopolitical uncertainty, That just added more fuel to the fire.
And the damage? Oh, it was significant. In just 24 hours, the rupee blew past the 91 mark to hit its new record low of 91.74. That's a really rapid depreciation that affects everything from import cost to inflation. And that brings us to the final piece of the puzzle. With stocks falling and the currency getting weaker by the minute, investors were desperately looking for a safe place to put their money. This triggered the third shockwave, a historic, unprecedented surge into precious metals.
The principle here is super simple, and it's something we see time and time again. It's called a flight to safety. Gold is seen as this universal store of value that holds up during times of economic or political chaos. So when investors get scared, they sell assets like stocks, and they pile into gold, which causes its price to just skyrocket because of that sudden spike in demand.
Honestly, this one slide tells you the entire story of January 21st in a single image. While the Sensex ended the day down, gold futures on the MCX were up over 5%. It's a perfect illustration of the fear that was gripping the market. Investors were literally running from equities and sprinting headlong into the safety of gold. Okay, so let's bring it all together. We've seen the chaos in the Indian markets, and we've identified the trigger in global politics. Now let's connect all the dots and see the clear chain of events that unfolded.
It's a really clear cause and effect sequence, right? It all started with those US-EU trade tensions over Greenland. That sparked a global risk-off mood, making investors everywhere super cautious. This led directly to foreign capital fleeing emerging markets like India. And the result of that capital flight? The rupee hit a record low and gold hit a record high. Each step just logically follows the last.
And that really brings us to the big takeaway here. The mayhem of January 21st is such a powerful reminder of just how interconnected our global economy really is. It leaves us with a critical question. In a world where a diplomatic fight over Greenland can crash the Sensex, can any of us ever really say our investments are purely local?
So what do you think? How do you protect your own investments from global events like this one? Let us know your thoughts in the comments. And hey, if you found this breakdown helpful, don't forget to like and subscribe for more explainers that connect the dots. Thanks for watching.